This is the most dangerous market ever. Look at valuations, have never been this extreme. If you're in these target date funds, these buy and hold funds, you are going to get slaughtered if you don't take measures in your own hands to just get ready to protect yourself.
You're watching Silver News Daily. Subscribe for more.
Imagine waking up to a financial world turned upside down, stock markets crashing, real estate prices plummeting, and inflation wiping out your savings. Michael Pento, a renowned financial expert, warns we're on the brink of a historic economic meltdown. But here's the twist. He believes silver could be your lifeline in this chaos. Why? Let's unravel this alarming prediction and find out how you can prepare before it's too late.
So what do you mean there's not sanity? I mean, don't you know fart coin deserves to be like the entire market cap of like France or British stock market? I mean, come on. This is the most insane time. I've been licensed now for 34 years. I think if you look at my neck, I just noticed that I'm showing my age a little bit here. So I'm 61 years old. I mean, there's a long time. I never remember. Not that I don't remember. It has never happened before that you had a triumvirate of bubbles in stocks, bonds, and equities. But bubbles are, they can exist for a long time. I mean, people are talking about bubbles in 96 and 97. Alan Greenspan says, irrational exuberance. They can continue for years, but then they always burst and they always mean revert. But this time you have to mean revert home prices, equity prices, and bond prices. Bond prices really, I mean, if you look at things like high yield bonds, the spread to treasuries is just about as tight as it's ever been in history. And then you have things like collateralized loan obligations, and you've got new things like private credit, which, so if you can't get a loan, if a business can't get a loan from the bank and they're highly leveraged and they can't even float debt in the corporate bond market, they just, go to like the shadow banking system and say, hey, here's some debt, finance it at a very low interest rate. And you can't get out of it. You don't price these. There's no pricing mechanisms for these bonds. It's private. So that means you're locked in. There's no liquidity. I mean, this is a big, big problem that we have once the recession hits, and there will be another recession. The yield curve, by the way, just normalized in December. That's not too long ago. And it usually takes around 3 to 6 months after the yield curve normalizes before you see a recession. And we had the longest inversion of the yield curve in history, and it was the second deepest inversion in history. The spread between the 2 and 10 year note. So I mean, I don't throw out my theory that we're in for a lot of trouble. I mean, I invest money for clients. We had a positive return in 2024.
Let's dive into the root of the impending storm, an economic crisis fueled by the Federal Reserve's relentless pursuit of its 2% inflation target. For 43 months, inflation exceeded this benchmark, yet instead of tightening its grip, the Fed slashed interest rates aggressively, including a staggering 50 basis point cut recently. Why? According to Michael Pento, the goal is not to curb inflation, but to sustain economic bubbles in equities and real estate. These moves also aim to ease the government's growing debt servicing costs and support the treasury markets. Here's where it gets critical: the aftermath of the COVID-era $5 trillion money printing spree. This flood of liquidity drove inflation to peak at 9% before a questionable retreat to 2%, a figure Pento deems misleading. He argues that the true inflationary pressures are far from subdued, warning that this manipulation of monetary policy has set the stage for an unprecedented crisis. What does this mean for you? Imagine a scenario where the rising cost of living continues to erode your purchasing power, all while risky investments spiral out of control. If the Fed's approach falters, could we face runaway inflation or a systemic collapse? And how might this affect your financial future? Stick around as we unravel the domino effect these decisions have on markets and why experts believe tangible assets like silver might be the ultimate safe haven in this volatile economic landscape.
So, it's not like I'm sitting here shorting the market. I'm just warning people. I'm not a Cassandra. I'm just warning people that this is the most dangerous market ever. Look at valuations have never been this extreme. If you look at things like price to sales or total market cap of equities to GDP, or if you look at earnings yields, so the risk premium, earnings yields minus treasuries, it's zero, if not negative. So what I'm doing right now is I'm only slightly long the market. I have a slightly net long position of about 15% long the market with hedges. In the portfolio, I have a tremendous amount of bonds on the short end of the yield curve. I think whatever's left in this bull market is not really worth the risk of being overly long in this. First of all, if you were in the 60-40 portfolio, think about 2022. So 60% stocks, 40% bonds. And that, by the way, that reverses as you get older, where you could have, say, 30% stocks and 70% bonds. If you look at long duration bonds, they are down 50% since 2020, 50. So your return on a bond fund that's out along the yield curve, you've lost half of your money, not in Bitcoin, not in Fartcoin, not in some pink sheet stock that doesn't trade. In U.S. Treasury bonds, you lost half of the value. So I think 2025 could look a lot like 2022 when you see these bubbles burst. For the timing, I rely on my model that I created. It's not time yet. It's not going to happen, on Friday, I don't think. But it's definitely something that's going to happen soon. And when it happens, it could bring down both bonds and equities concurrently. Along with real estate, it could be very, very dangerous for the 60-40 buy and hold portfolio. So I would maintain an extreme flexibility and have a robust model, an algorithm that lets you know when to get out of harm's way, when to go into short-term treasuries, when to go into cash, when to go into the dollar, which, by the way, the dollar's been working spectacularly if you're long the dollar. So that even could get even worse. As far as the appreciation of the dollar, and you must be able to short the market adroitly. That's my plan.
Now let's turn our attention to a critical warning signal flashing across the economy. The bond market. Michael Pento describes it as a ticking time bomb, plagued by a dangerous liquidity crisis. Over the past year, the Federal Reserve's reverse repo facility, a key tool for maintaining market stability, has plummeted from $2.5 trillion to a mere $80 billion. This dramatic drop reveals a dire lack of liquidity, sending shockwaves through the financial system. But it doesn't stop there. Long-term bond yields have surged despite the Fed's interest rate cuts, a paradox that highlights growing distrust in U.S. fiscal stability. Investors are starting to question whether the government can sustain its ballooning debt, now burdened with over $1 trillion in annual interest payments. Pento predicts that if foreign demand for U.S. bonds continues to wane, the implications could be catastrophic. Rising long-term yields would push borrowing costs even higher, exacerbating fiscal instability and threatening to unravel the financial markets. With projections of a $6 trillion federal deficit during the next recession, can the U.S. maintain confidence in its debt? Could this liquidity crisis be the harbinger of an economic collapse? And more importantly, how should you position yourself to survive this storm? Let's explore the ripple effects of these market imbalances and why experts are urging investors to take action.
And by the way,
it's too late.
Before I make the statement, we've had bubbles in real estate before. The real estate prices dropped by 33% nationwide. The Fed cut interest rates to zero and fixed the problem eventually, right? The stock market has fell apart in the global financial crisis. It fell apart in 2000. From 2002, it lost 50% the S&P. But the Fed was able to come to the rescue eventually. Not that you losing 50% for a few years isn't a problem. It's a problem. But the Fed was able to fix everything by what? By lowering interest rates and printing a bunch of money. It's not a guarantee, but there's a very significant risk and it was in my model. I predicted it. It's happening. Doesn't mean it's going to continue to happen. It's like guaranteed to happen. But when the Fed lowers interest rates next time and the economy experiences a problem, the insolvency condition of treasuries and the fact that inflation is still salient in the minds of investors. We haven't returned to 2%. We're no longer growing at 9% inflation. We're down to 3. Congratulations, but you already bankrupt the middle class. But it's a combination of inflation and insolvency, because I think deficits can go to $6 trillion. The annual deficit can be $6 trillion in the next recession, just based on the last 3 recessions and the percent increase in the deficit. $6 trillion. You could have bond yields spike even in a recession. And even if they don't spike, they might not come down, especially on the long end of the curve, the way they usually do. I mean, the Fed controls the short end of the bond market. I'm not saying that they can't lower the Fed funds rate to 0. They'll be late to the game. They'll be reticent to do it because they know what happens. They already know what the inflation is going to come, and they don't want that. But they'll eventually have to do that because, if the choice is inflation or a depression, they'll always, every central banker, not just the Fed, they'll always choose inflation. It's just much easier to lie about and hide. But when you talk about the total, bankruptcy of the financial system vis-a-vis, intractable inflation, they'll always choose intractable inflation. And that, I believe, will cause yields to spike to levels even higher than they were in 19.
Let's talk about the mounting debt crisis and how it's distorting the very foundation of our economy. Michael Pento sounds the alarm on negative real interest rates, where inflation consistently outpaces nominal interest rates. This creates an environment where traditional savings lose value over time, pushing investors to chase riskier assets like stocks and real estate. Take a closer look at what's happening. During the era of cheap borrowing, institutional players like Blackstone acquired massive quantities of single-family homes, driving property prices to unsustainable levels. But now the tides are turning. As mortgage rates inch toward double digits, the real estate market is facing immense pressure. Pento foresees a steep correction, even if the Federal Reserve steps in. The math is simple. Higher borrowing costs make inflated property prices unsustainable, leading to a potential domino effect in real estate. At the same time, soaring U.S. debt has created an untenable situation. Interest payments on the national debt have surpassed $1 trillion annually, a burden that will only worsen as rates rise. This relentless borrowing and spending spree, Pento warns, has created a fiscal time bomb. The critical question is, how long can these imbalances persist before the system buckles under the weight of unsustainable debt? And in the face of this looming crisis, what strategies can protect your wealth and financial security? Stick around as we explore the options.
This is the beginnings of these tremors. And when you have rates that are rising on a record amount of debt, we have a record amount of total non-financial debt as a percentage of GDP is at an all-time record. So there's a tremendous amount of debt out there. And when you see rates rising on that debt, and the debt was used to engender these asset bubbles that I just talked about, stocks, bonds, and real estate, you have the most dangerous cocktail we've ever seen. So please, I hope your audience is in the millions. And but if even there's an audience of like 2, I know you have a very high audience. I'm not deriding your audience. Your audience is growing and it's very vibrant. I'm saying I wish that you had. I could tell everybody, because I've been thrown off the mainstream financial media. Everybody needs to know that if you're in these target date funds, these buy and hold funds, you are going to get slaughtered if you don't take measures in your own hands to just get ready to protect yourself. Now, I'm looking at national, I'm looking at total, I'm looking at financial conditions, and I'm looking at credit spreads myopically to let me know, not when I think it's time to worry, not when I had a bad dream last night, not when somebody on CNBS says, hey, you know what, I think the 200-day moving average is in jeopardy here, but it's going to be support. I need to know the arcane components of the market that I look at in my 20 component model that let me know when the big boys on Wall Street, the insiders that know what's happening with the CLOs and the private credit, when they know that their assets are deteriorating and the cash flows are going dry, when they know before anybody else will come on CNBC and tell you, they start selling. They start buying insurance. Like they start buying credit default swaps. And that sends the financial conditions index higher. And you'll see people selling junk bonds and heading into treasuries. The insiders, the people that know, that's where my fingers are on the pulse of. And I will take actions because I think that the danger in this market is going to be like we've never seen before. And I'm not being, I'm not trying to use hyperbole here. The reason why I say that is because we do have record asset prices. That's a fact. But what I'm most worried about,
Real estate, once a cornerstone of stable investment, now sits precariously on the edge of a significant downturn. Michael Pento has been clear. The factors that propped up this market, like low interest rates and cheap credit, are evaporating. Mortgage rates, which once hovered at historical lows, are now climbing toward double digits. The impact, an imminent squeeze on both buyers and sellers. Picture this. Families struggling to afford homes at today's prices, investors retreating from the market, and a growing inventory of unsold properties. Pento highlights that the real estate market has become heavily inflated due to speculative buying during the years of low borrowing costs. Entities like Blackstone acquired properties en masse, driving prices far beyond what most people could afford. Now, as borrowing costs soar, demand is cratering, and even large investors are facing challenges in offloading assets at these inflated valuations. What's more, if this correction accelerates, the ripple effects could extend far beyond housing, impacting jobs, construction, and lending markets. So here's the pressing question. Could this be the start of a housing market crash that ripples across the broader economy? And if so, where does that leave you? Don't miss what's coming next as we delve into why experts, like Pento, see tangible assets like silver as a hedge against this impending instability.
well, there's a letter called, I think it's the Kobayashi letter, that put out a very good stat. The leveraged long positions in these leveraged ETFs are 100 times greater than short ETFs. So that's why there's no margin, but there's a lot less margin debt on the NYSE. You don't have to have a prime broker and borrow in a type 3 margin account, short them, and you have come up with money and pay interest and all this. You have to pay the dividend. You could just buy a leveraged ETF if you want juice in the market. So it's belying the fact that there's a lot of leverage out there, and it's all in these leveraged ETFs. And 100 times more than you find in the inverse ETFs. So that means the I don't care what sentiment says, the fear of missing out, the FOMO, and the speculation in the stock market has never been greater in the history of my 34 years of being a licensed professional. And that means it's just a tremendous amount of downside. And, you think, people say, I hear it over and over again, Donegan. They say on the mainstream financial media, well, don't worry about it because the government and the Fed has your back. If we have a downturn in the economy, or if we have a hiccup in the stock market, or home prices start to fall and bank assets start to come under pressure, we'll just cut interest rates. Well, the funny thing is, the Fed is in an interest rate cutting regime. You know that, right? They've cut interest rates by 100 basis points, and every single part of the yield curve has seen bond prices fall and yields go higher. Every single part. And mortgage rates are up 100 basis points, 1%, since the Fed decided it was a very necessary move to cut interest rates, because they understand. Don't listen to me. Listen to Jerome Powell. He gets it. That's the reason why he's cutting interest rates. He's cutting interest rates because the Treasury cannot afford interest, $1 trillion plus interest on the national debt. And they see bank assets are coming under extreme duress here. And so he's trying to get the borrowing costs of the consumer and for corporations down, but it's the exact opposite that's happening. I don't care what he's doing. Borrowing costs are elevated. Interest rates are rising. The interest rates in the United States are the highest in, I think, 18 years. 18 years. And it's not just the United States. In the United Kingdom, they're the highest since 1998. So we have a global revolution in the corporate and sovereign bond markets. That's just the nascent.
Now, let's shift our focus to the shining alternative that Michael Pento believes could serve as a lifeline amid economic chaos: silver. While stocks and real estate markets teeter on the brink, silver is emerging as a reliable hedge against inflation and financial instability. But why silver? And why now? Pento points to silver's dual role as both a monetary asset and an industrial metal. This duality makes it uniquely positioned to thrive in volatile markets. On one hand, silver's status as a store of value offers protection against the eroding effects of inflation, especially as central banks continue their policy of printing trillions to sustain economies. On the other hand, industrial demand for silver in technology, energy, and medical sectors ensures its long-term utility and growth potential. The supply-demand dynamics also work in silver's favor. Global silver production has faced constraints, while demand, particularly for green technologies like solar panels, continues to surge. This imbalance creates the perfect conditions for a potential price rally. So, how can you take advantage of this opportunity? Should you consider investing in physical silver, ETFs, or mining stocks? And could silver truly outshine gold as the preferred asset in this economic storm? Stay tuned as we unpack these questions and reveal strategies to make silver work for you in times of uncertainty.
Okay, so I mean, it's a very generic question, and I have to know the macroeconomic environment. But going into this interview, as I indicated already, we have a slightly net long position. But going into a recession, we would be in what I call sector one, which would be bond and bond proxies. And you have to know what part of the yield curve. For example, bonds were down 20% in 2024, but if you owned 1 to 3 year treasuries, they were unchanged. Bond price. I'm talking about bond prices. So you kept all of that yield. But if you went out along the yield curve, you're down 50% in the last 5 years, as I mentioned. So you wiped out, most of your gains that you made in the stock market over the last couple of years, especially if your bond sleeve of the portfolio was greater than your stock, your equity portion. So I'd be sector one, which is bond and bond proxies. You could have a little bit of gold there, but you have to worry about a liquidity crisis because gold will be sold in a liquidity crisis and you will be short the market. I think there's a tremendous amount of money to be made shorting the stock market. As I said, I think the Fed will be late to the game, and they're more impotent than ever before because they can't control the long end of the yield curve so easily. I mean, they can assent to buying every single bond issue like they do in Japan. But if you want to talk, we can turn the United States into Japan, which has in dollar terms the same GDP as they had in 1989. And the stock market is still down from where it was in 1989. So if we want to be Japan, we can be Japan. But first, you're going to lose, half of the market value of equities. So they can assent to do that, but you're talking about intractable stagflation. Then after, this is the second part of your question, I think we're going to have to be positioned for stagflation, which is energy, base metals, precious metals, shorting long-term bonds. That is what I will do. For me and my clients, my money is where my clients' money is. Same strategy.
Now, let's address one of the most debated mechanisms meant to keep government spending in check: the debt ceiling. Michael Pento isn't convinced it's doing its job, and his critique sheds light on just how ineffective this tool has become in preventing fiscal mismanagement. Despite the heated political battles over raising the debt ceiling, the end result is always the same: more borrowing and spending. Pento highlights how stopgap measures have recently added over $100 billion in expenditures, a reflection of a system that lacks meaningful fiscal restraint. Instead of enforcing discipline, the debt ceiling merely serves as a temporary hurdle, delaying the inevitable increase in debt. What's worse, mandatory spending on programs like Social Security, Medicare, and defense means the majority of the budget is untouchable, leaving little room for cuts or reform. Pento suggests an alternative, a debt-to-GDP cap. This approach would tie government borrowing to the economy's growth capacity, encouraging stability and discouraging reckless fiscal policies. But here's the question. Would such a reform even be politically feasible? And if not, what are the consequences of continuing down the path of unchecked debt accumulation? Could this lead to diminished confidence in the dollar or even a runaway inflation scenario? Stick with us as we explore the deeper implications of Pento's insights and why tangible assets like silver might be your safest bet in this turbulent landscape.
It's very, very dangerous. It's okay. Okay, so Mr. Pento, I guess the Fed will just keep interest rates at zero and we won't have a problem. Well, I mean, you talk about hyperinflation. That's what it's not that this country is immune from the effects of economics. The machinations of economics, the laws of economics, don't change and dry up or stall out on the shores of the United States. We have never, in my history, and it's a long history I indicated, thought that the Federal Reserve would print trillions upon trillions of dollars in a matter of a few years. But just rewind the clock back to 2007. The Fed's balance sheet was $700 billion in 2007. And really just a few years later, we're not talking about a long time, right? We're talking about maybe 17 years, 18 years, 17 years. We went to $9 trillion in the Fed's balance sheet. They monetized, created out of thin air by fiat, by decree, credit, which is the same. It's part of the high-powered money. It's the same as printing money. It's Fed credit. Fed credit can be used. It's the money that banks use to buy bonds, but that can be used and converted to cash. They created trillions, over $8 trillion. That was unthinkable in the 90s and in the early part of the 2000s. Never. But we did it here. And so when people say, well, we'll never have hyperinflation because of let me just take that on for a second. We'll never have a problem in the bond market. I hear it today. We'll never have a problem in the bond market because the U.S. dollar is the world's reserve currency and the U.S. bond market is the most liquid and blah, 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 blah. But wait a second. Was the U.S. dollar the world's reserve currency in 1980? Yes, check. Was the U.S. bond market the most liquid bond market in the world, in the planet in 1980? Yes. But inflation caused the Fed funds rate to go to 20%. Volcker had to take the Fed funds rate to 20% because the Treasury, the benchmark Treasury went to 16%. So why can't it? You could have all those things are true. The bond market is the most liquid and deepest in the world, and the dollar is the world's reserve currency. But interest rates have to rise to represent inflation, and that is where I think we're going. I think we're going into intractable stagflation after we see this next iteration of recession, which I think is going to happen in 2025.
As the economic storm clouds gather, Michael Pento emphasizes the importance of rethinking investment strategies to navigate this uncertainty. He strongly advises shifting focus toward tangible assets like silver and base metals, as they offer a hedge against inflation and economic instability. The reasoning is clear. Traditional investments, such as bonds, lose their appeal when real interest rates remain negative. Inflation erodes returns, and with U.S. debt surpassing $34 trillion, the bond market faces diminished foreign demand and credibility. Equities, meanwhile, are hovering at historic overvaluations, leaving investors vulnerable to sharp corrections. Enter silver, a tangible real-world asset that not only stores value, but also offers significant upside potential in the current economic climate. Industrial demand, particularly from green technologies, bolsters its growth prospects, making it a versatile choice in turbulent times. Pento also points out that base metals and energy assets provide similar stability and are essential components of any inflation hedging strategy. The big question remains: how do you strike the right balance between these tangible assets and other investments in your portfolio? And what steps can you take now to protect your wealth before the financial storm hits? Coming up, we'll break down actionable strategies to help you stay ahead of the curve.
So there's private. So you have to look at private source data too, not just the Labor Department. So Challenger, Gray and Christmas just said they just calculated that we had the lowest hiring plans announced since 15 years. The lowest hiring plans in 2024. I think it was like 769,000 net new hiring plans in 15 years. So how robust really is the labor market? Now, the unemployment rate is quiescent still. It's still way below the average. But that begs the question: if the stock market is in a massive bubble, you can't make an argument for cutting interest rates because the stock market's in pain, and you can't say, well, home prices are dirt cheap. We have to get the home prices up a little bit, and the unemployment rate is quiescent. What is the real reason why the Fed is in a rate cutting cycle? I mean, what the Fed has appropriately said that they instead of cutting rates 3 times in 2025 this year, they're going to cut like maybe once or twice. So they're going in the right direction. But why are they cutting rates at all, given what you just indicated? So the inflation target has been missed to the upside for like almost 40 months. Like 40 months now, almost 40 months. 40, not 40. How in the world can you miss your target on inflation to the upside and be cutting interest rates, especially when that target is being missed more in the opposite direction? I mean, the rate of change is increasing. Second derivative. So I don't understand what the Fed is doing, other than the fact you have to agree with me. They're worried about keeping interest rates on debt service down, so they're lowering all of our debt is financed on the short end of the yield curve, T-bills. So that's good news, I guess, if you can say, well, it's good news. They could just cut interest rates. But you're also rolling over the debt all of the time. So if the Fed ever has to, assent to the notion that, hey, inflation is a big problem, we're going to have to raise interest rates, you're rolling over that debt, which is a massive debt. You're talking about with $34 trillion, $35 trillion, rolled over every single year. That's the direction we're going. I don't know why we didn't lock up long-term rates. When the 30-year bond was like 1%, why didn't we just issue 30-year bonds? But the geniuses at the Treasury Department said, hey, we need to finance all this debt on the short end, so we have like a floating adjustable rate mortgage on our debt.
Michael Pento's predictions take an even darker turn as he forecasts an imminent recession, one that could redefine the economic landscape. According to Pento, the U.S. economy is nearing a tipping point, with conditions set to deteriorate as early as March 2025. A combination of surging deficits, weakening employment data, and rising long-term bond yields paints a troubling picture. Consider the warning signs. The yield curve inversion, often a harbinger of recession, has returned to normal, but history tells us that recessions typically follow within 6 months of this occurrence. At the same time, unemployment claims are rising, corporate layoffs are accelerating, and hiring is slowing, clear indicators of economic contraction. Pento predicts that deficits could balloon to an unprecedented $6 trillion annually during this downturn, as government borrowing spirals out of control. Meanwhile, tightening lending standards and soaring interest rates make it increasingly difficult for businesses and consumers to access credit, further stifling economic growth. How severe could this recession be, and what does it mean for markets, jobs, and everyday Americans? As we approach the apex of this discussion, We'll tie these elements together and explore how silver and other tangible assets might offer a lifeline in a collapsing financial system.
Well, there's two things you could do. Well, number one is I have multiple homes, so I'm selling one of my homes. I'm in the process of doing that. In fact, I'll probably sign the listing agreement this week. It's one of the things I'm doing, putting my money where my mouth is. The other thing is, I think you could short bank stocks because the assets they hold in CMBS and MBS will just devolve in value. I mean, they'll just plunge. And banks have had a massive run up because everybody's talking about, well, the economies are going to be great in 2025. So people have been buying banks, steepness of the yield curve, blah, blah, blah. So after, not now, I wouldn't do it now. I would not short banks now. I'm saying after you see the whites of the eyes of a recession become manifest, my model is built to do that. That is when you would short bank stocks.
Speaking of your model, can you let people know how they can take advantage of you actively managing their funds if they so choose?
So there's a website, pentoport.com. I have a midweek reality check there. You can get my 36,000-foot view for $50 a year. And if you want me to specifically manage your money, you need $100,000. You need to qualify for the portfolio, and you need to be a U.S. citizen. And you can use the contact page to send me an email, and someone will get back to you. The most important thing I can leave you with, Dunnigan, and your audience is please don't fall asleep. Don't fall victim to this. Fed's got your back. Government's got your back. There's never going to be a problem in the stock market again. This is the wrong time. This is just, no matter, even if I'm wrong about the recession this year, and I could be, this is the wrong time to start going leverage long exposure in the stock market. I think there's just the odds of you're making significant money in the stock market above what you can get in a safe U.S. Treasury on the short end of the yield curve are very, very low.
It all comes down to this. Michael Pento's dire warning of a financial meltdown isn't just speculation. It's the logical outcome of years of unsustainable policies and mounting economic imbalances. From the Federal Reserve's relentless rate cuts to sustained bubbles, to a staggering $34 trillion national debt, the signs are clear. A seismic shift is on the horizon. Pento's forecast is sobering. A deep recession, potentially starting in early 2025, could expose the vulnerabilities in overvalued markets from equities to real estate. With deficits projected to swell to $6 trillion annually, the bond market could face a credibility crisis, eroding confidence in U.S. debt and the dollar. Inflationary pressures would only worsen, devastating the middle class and diminishing the value of traditional investments. So, where does silver fit into this picture? Pento argues that in a world where fiat currencies falter, tangible assets like silver could emerge as a critical hedge. Its dual role as a monetary and industrial asset positions it uniquely to preserve wealth while offering growth potential. Whether you choose to invest in physical silver, mining stocks, or ETFs, it's clear that ignoring this opportunity could be a costly mistake. The time to act is now. Are you prepared to safeguard your financial future in the face of this impending crisis? Consider the steps you need to take today to protect your wealth. And don't forget to subscribe to this channel for more insights on navigating turbulent economic times. Remember, this is not financial advice, but a call to stay informed and take control of your future.